welcome to ICICIdirect. Joining us now is Swarup Mohanty of Mirae Asset India. Swarup, pleasure having you today on the show. It's been a very busy last 24 to 48 hours for the industry, for the markets, for investors, and of course, for advisors like yourself. This has largely been a growth-focused budget. India Inc. markets both seem to be cheering in. Inflation concerns have been ignored. It's going to be all about the RBI credit policy in the next couple of weeks. But let's begin with how you feel about this budget. Were you surprised? Did the budget match up with your expectations? How do you see things playing out from here on?
Samina, first of all, thank you so much for having me. But I must confess that this is the first budget which did not surprise me at all. We expected a growth-linked budget, and that's what came. What really was good to see was the numbers are extremely realistic, and that's a view we've had on previous budgets that some of the numbers looked out of place. But we feel this is a realistic budget. More important, very future-ready budget, bringing in digitization and the green part of the world or the environmental part of the world, leaving its footprint across the budget. So overall, we're quite happy with the budget.
Swarup, what is the market cheering apart from the budget event getting over, as well as US markets also doing well overnight? I do understand it's a no surprise, no shock budget, but bond markets don't seem to feel like that.
Yeah, I think the bond markets are, more towards the inflationary side of the budget, which, as you rightly pointed out, the central bank should come in and address. That's a different part of the story. But in the interim, when the story just unfolds, that was the knee-jerk reaction which happened, which the central bank should come and address. So the bond markets are right in their own place. It will be inflationary in nature, but that is the situation that we are in. I mean, my only grouse with the budget has been it's not addressed or not even spoken on the word called COVID, which we are in, and you cannot ignore the fact, and some of the impact of that will play out, and one part of it. And whenever you look at a growth-linked budget, some amount of inflation does come in, and hence that reaction on the debt side.
Swarup, as far as the borrowing program is concerned, with the gross borrowing number coming in so high, I'm not sure if you got a chance to look at it. Could you make note of it that at 6.4%, also the street was anticipating 13 lakh crores of gross borrowing, and it's now coming at 15 lakh crores, even at a 6.4% fiscal deficit?
So I think that is what is the worry which has led to the knee-jerk reaction on the bond market. But we feel it is doable, and you've seen that the star of this entire COVID phase has been the central bank, and all credit to them for have managed it so far, and we do expect them to come back and do their job. I mean, I have not seen the central bank so active in my entire years of working when you compare to the last 2-3 years. So though it looks tough, but I do believe that the central bank will come in and do its job and enhance the possibilities of this happening. We are pretty confident.
Swarup, ahead of the budget, I think the street was expecting a very pro-consumption budget. Has this met your expectations? Do you think enough has been done to spur growth, demand from rural India?
See, I think when you look at the capex-led budget that it has put in place, one has to watch the what can I say, the efficiency in which they implement this budget. Our only take is that, I hope and pray that the capex is played out throughout the year. If you look at the history last year, most of the capex was left to the last quarter of the year, which is not something which we would like it done. We hope that it is spread across the year. And if it is spread, it will lead to a lot of increase in infra. And in 2022, if we are still talking infra, then it speaks of the overall state of the country. I wish it was not that big a focus yet, and the work had been done earlier. But all said and done, it is an infra-led budget, and it's a heavy capex-led budget. And some of the data points, if I were to put in perspective, are very clear that it is going to lead a fair amount of growth on the. If you just think of the manufacturing PLI, the lower corporate tax or the push on electronic production, the defense manufacturing with Indian organization, all this will lead to a fair amount of push in across board, not just any one part, the across board welfare of the country, and everybody should benefit. Yes, the key again, I bring in the fact that the implementation of this capex led or the amount that has been put on table should be done ruthlessly and efficiently. And if that happens, yes, everybody should benefit.
Right. In that case, Swarup, then what does this really mean for the markets, right? Do you think with an increased cost of capital on the horizon, we've seen the way the Fed has moved. We've also now understood that with a great and aggressive push to growth, it is going to fuel inflation dramatically. And all this in the backdrop of tightening global liquidity. How do you think cost of capital is going to impact markets, earnings? Do you think we as investors need to moderate our expectation in terms of returns for this year?
See, to answer your question, let's just put the budget out of the picture and put things in context. When you look at the globe, so a lot of what you're saying is correct. And let's look at the inflation in the US. We're talking about above 7 inflation, which probably 2 or 3 generations would have never seen. And they're grappling with that themselves. And some of it will spill over to the rest of the world, and we will not be an exception. The market understands this. The market has already factored in. One of the big reasons for the market slump in the last 2 days or 3 days was more to do with the global market slump than the budget, right? And with the reversal of the US market, you did see a bounce back of the Indian markets. Too short a time to comment on, but I'm just saying how they are correlated, right? And the market already anticipates a lot of it. And if you look at the broad run-up of the market prior to the budget, a lot of the easy money is already behind us. And that's something which all of us have to keep in mind and put things in the right perspective. Even today, when you're looking at the growth pictures being put, or the numbers which are being put for the future, a lot of it has to do with the low base that we are already in, right? We've had 2 years or 3 years of good low cost of capital regime. So some amount of reversal to mean has to happen on that front, keeping in mind the overall liquidity squeeze which could happen globally. I don't think the market does not understand this. The market understands this. And at the same time, if you look at it from a fund management perspective, it gives scope to a lot of other areas of work which were not there in the future. While in the initial part of our discussion, you did reflect on the fact that a lot of it could shift to a lot of value buying, which is now looking very much possible before this entire manufacturing onslaught in India comes in. But to put things in perspective, yes, the easy money is definitely behind us. A more realistic growth and more realistic expectation based on balance sheet growth and earnings will be the way forward for wealth creation.
Swarup, while easy money is now behind us, do you think with this big, indication of growth, capex, infrastructure, long-term growth, new age budget, those are some of the words I've been reading, is enough to keep FPIs to bring back foreign money into India?
See, again, I'm keeping the budget in isolation because, see, the budget is just one intervention in the overall wealth creation or the economic development of any economy. And if you keep the budget outside, and especially post-COVID, India definitely goes into a place of strength. I mean, compared to the rest of the globe, I think when this all the haze around the COVID goes out, and then things sort of stabilize, though I don't know when, India with every passing day is getting into a stronger position than it was pre-COVID. I do believe that COVID in that way has helped India on a global scale far better or far quicker than the normal pace was. So irrespective of the budget, I do believe that India will remain a place of focus for the globe. And I see that from a Mirae perspective, from a global perspective, we see a lot of focus from our head office on India as such. And the basic correction that was needed in India, which our biggest advantage of low cost manpower and the young demography now is being directed towards a good manufacturing led sort of vision. And if we can deliver that in the next 5-10 years, there is no reason why India cannot become the focus of a lot of global players in the world. I mean, something which was going to Vietnam and countries like that could definitely come to us. There is a big possibility, yes.
The China plus one strategy.
Yeah, the China plus one story, yes.
Favor. Very lastly, Swarup, so as an investor now, how should one construct their portfolio? One, on an asset level, and second, in terms of sector allocation potentially. With the push to infra, will the markets now focus on infra, cyclical, economic sectors, corporate banks, capital goods? This segment has been kept quite happy in terms of announcements, at least.
Samina, personally speaking, this infra space has, from a wealth creation perspective, has always flattered to deceive. So I will watch that space a little with a bigger microscope and or whatever you call it than ever. But I agree with you that the banking space looks very good. Let's face it that the credit cycle today looks far stronger than what it was in the last 2 years. A lot of the toughness in that space, and let me tell you that it's been one of the worst credit spaces that one has seen in one's career in the last 2-3 years. That is getting out, and the banks today look far better on the balance sheet space, especially from the NPA space going forward. So our house view on the banking has been for a year, and we carry that view, and that's become stronger after this budget. But when you look at portfolio construction is definitely divided into two parts: the core part and the satellite part. And the core part remains strong and gets stronger on the manufacturing side as we speak. In fact, we've launched a very interesting ETF led on the made in India concept, because we do believe the next 5-10 years this can happen to India. But on the satellite space, and if you look at this budget in particular, it has left the digital imprint across, from education to a digital rupee, just showing that this is a space which is there for the future. The other part is, very interestingly, through the green bonds and say the battery swapping, India is also recognizing the environmental space. So this is something which is a submission, is that whenever I talk of ESG in the last 2-3 years, people started saying that it was a fad. Then they said, okay, it's a theme. I do believe ESG is a core part of everything that we say going forward. And India, through this budget, is beginning to recognize that and building an environment for an environment-friendly country. So the core part of the portfolio definitely looks solid as ever, and one should get even more strengthened in their belief on India. The number two is, when you look at the satellite space, there are a lot of very, very interesting spaces developing. And at the beginning of the discussion, we were saying that we will see a lot of stories coming on that space from the mutual fund side, on the passive side also. So the choices for building a portfolio for the investor, and more important for an advisor, are increasing. And hence, it's a very interesting time to be an investor, to create wealth. And in next 5-10 years, India is in a very unique space, because, and I speak from a mutual fund perspective, because there is enough talent in India which will give you alpha generating returns on the active side. And at the same time, you will see a plethora of exciting ideas coming on the passive side. So India probably is the only country which is in a stage which will give these two options to an investor simultaneously. The rest of the globe has moved to the passive side. So very good times if I were an Indian investor. Stick to your investment objectives, and it can be achieved in the next 5 years. Very exciting times for India.
And as exciting for an Indian fund manager, Swarup. Thank you very much for joining us on the show. That was a great sort of review of the budget and the outlook on the markets. Thanks for joining in.
Thank you so much, Samir. Thank you so much for having me.
Investments in securities market are subject to market risks. Read all related documents carefully before investing.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.